Hello and welcome to Money Unshackled, the headlines. Boris Johnson U-turns again by breaking Conservative manifesto pledge not to increase national insurance, income tax or VAT. Average UK house price hits eye-watering 8 times average salary. Mortgage price war ramps up as Nationwide offers record-breaking sub 1% 5-year fixed rate deal. Lloyds Bank plans big move into the UK rental market by becoming the UK's biggest landlord with 50,000 homes.
Contactless card payment limit to increase to £100 from October. Expected to be a thief's dream. James Dyson is telling you to get back to work. Dyson says that working from home makes firms less competitive. The UK's finance watchdog declares Binance is not capable of being supervised.
The Royal Mint has recorded a 5-fold rise in young adults taking a stake in gold. Is it time to protect yourself against inflation? Interactive investor lines up banks for blockbuster London flotation. And finally, the UK faces a £371 billion savings shortfall.
In today's episode, we're trying something new. We've gathered all the latest money news from the past few weeks that matter most to your finances. If you find this financial news bulletin useful, then hit that like button and let us know in the comments. Let's check it out.
Don't forget to check out the Money Unshackled offers page, where you'll find free stocks, hundreds of pounds of free cash in welcome offers, and discounted memberships to stock analysis tools like Stockopedia. Stockopedia will help you pick stocks like a pro, and with our link you'll get a free 14-day trial followed by a 25% discount linked to in the video description below.
Boris defies Tory fury to gamble on huge social care revolution funded by a £12 billion a year tax raid, reports the Mail. Boris warned that the NHS cannot recover from a pandemic without a massive cash injection. The government will raise national insurance by 1.25%. He also said that dividend tax rates are to increase by the same amount, delivering a hammer blow to the country's hard workers. Yahoo Finance says it's the biggest UK tax increase for 28 years.
This shocking revelation comes on the back of a Tory manifesto pledge not to increase national insurance, income tax or VAT. Compulsive liar Boris increases 2 in one fell swoop. Some would say we all should have seen it coming. We're now asking the question, is British politics broken? How can we end the two-party system?
Bad news for people trying to get on the housing ladder, as house prices have continued their ascent in the UK, with the average home now costing more than 8 times the average salary, according to Yahoo Finance. Over the past year, the average house price of UK cities has grown by 10.3%, while earnings for those living and working in cities rose just 2.1%, according to Halifax.
House prices in UK cities rose to £287,000, while wages only rose to a little over £35,500. This increased gap between house prices and earnings has lifted the price to wage earnings ratio to 8.1 from 7.5 in 2020. Unaffordability is now at its highest level since Halifax began collecting the data in 2011, and it's likely to be the least affordable market ever due to trends since the financial crisis of climbing house prices and stagnating wages.
Perhaps more worrying than just the cost of houses is the direction of travel of affordability. From 2011 to 2013, the price to wage earnings ratio for UK cities was 5.6 times earnings, but it has now risen for 8 successive years.
In mortgage news, the mortgage price war ramps up as Nationwide offers a record-breaking sub 1% 5-year fixed rate mortgage deal for those with 60% loan to value, reports This Is Money. We here at Money Unshackled warn people of the dangers of long-term fixes. Life is very unpredictable, and being locked into a mortgage often means big early repayment charges should you need to exit the agreement early.
But nevertheless, such a competitive deal for 5 years is an indicator that the banks think interest rates will remain low for years. Or in other words, they're clearly not concerned about rising inflation, which has been the fear story doing the rounds recently. It is being predicted that with Nationwide having stepped up the mortgage price war, that there is now some expectation that rates might yet fall further amongst other lenders. Reassuring news for those of us who are highly leveraged.
They go on to say that the mortgage market is distorted, with those with big deposits getting much better deals than those who don't. The average 5-year fixed deal for those with 40% equity is 1.81% according to Money Facts, whilst for those with just 10% equity, the average rate is 3.47%.
That's a gap of 1.66%, whereas just prior to the pandemic, there was just a 0.8% difference. Clearly, banks think that higher LTVs pose far greater risk. With house prices continuing to climb to record highs, we agree, because a small and increasingly likely correction could push many homeowners into negative equity.
The last bit of property news is on the investment property sector. Lloyds Bank plans a big move into the UK rental market by becoming the UK's biggest landlord with 50,000 homes. The Guardian reports that their target is to buy 10,000 properties by the end of 2025, then 50,000 by 2030. This is no tall order, as it was only in the last month or so that Lloyds announced its entry into the private rental market.
According to housingtoday.co.uk, the biggest private landlord in the UK at the moment is Granger plc, which has a stock of just over 9,000 homes and a pipeline to build about a further 9,000, so Lloyds plans on dwarfing the next biggest private landlord.
An estimated 1 in 5 households in the UK rent privately, and Lloyds predicts demand will increase over the next 5 years. We have to agree with them. There is an obvious supply and demand issue causing rents to skyrocket and house prices to continue climbing, as we have seen. Amateur landlords have been quitting the buy-to-let market in recent years after George Osborne's efforts to professionalise the market by introducing further regulatory requirements and harsh tax changes.
We're not sure how we feel about banks buying property. While we recognise that this country is in desperate need of an increased supply in housing, is a bank the right company to do it? Banks have a licence to print money, and surely this gives them some sort of unfair competitive advantage. House builders will have less reason to sell to you, as they will prioritise Lloyds, who are guaranteed not to have any buying problems, such that a normal landlord might have. After all, they're a bank with easy access to financing and are likely to be able to get lower rates of interest than any other private landlord.
And on the subject of home building, John Lewis, the department store retailer, is considering plans to build 10,000 homes over the next decade. They have apparently enough excess space on the land they own to build at least 7,000 homes. It does seem a little peculiar for John Lewis and Lloyds to enter the housing market, or perhaps it's stranger that it's taken them this long to enter the fray.
From October 2021, the contactless card payment limit will increase to £100 from £45. Expect it to be a thief's dream, says the Telegraph. The contactless limit was first set at £10 in 2007 and has been rising rapidly in recent years.
Chancellor Rishi Sunak said the move would make it easier to pay safely and securely, as well as provide a welcome boost for retailers and shoppers. What has this guy been smoking? We can't imagine anyone would end up spending more just because they no longer have to enter a PIN number. I was going to buy some wireless headphones, but because I was required to enter 4 numbers, I chose not to. Said no one ever.
The Telegraph cite experts who have warned that raising the contactless limit could further fuel the fraud crisis, giving thieves access to more significant amounts of cash from stolen cards. We totally agree. Many people also carry multiple cards, potentially putting them at even greater risk of being targeted by thieves.
The banks will obviously have an increase in refunds due to theft, but it's the customers that ultimately end up paying with increased banking fees. So with this said, is 4 numbers really that much of an inconvenience for larger purchases? Surely a better solution would allow customers to set their own individual limits at their own risk level.
Looking at the most worthy financial news from the tabloids now, a woman in America hates spending money so much she hasn't done any laundry for 3 years and never uses toilet paper. This commitment to frugality will warm the hearts of many a dedicated fire enthusiast. With a budget of just $200 a month in living expenses, she finds ways to reuse whatever she can to make her money go further. She has never paid money for furniture and instead sources her stuff from skips and off the street. That's one way to be financially free, folks. Credit to the Sun newspaper for this important story.
Billionaire inventor Sir James Dyson is telling you to get back to work. Dyson says that working from home makes firms less competitive. Is he right? Yahoo Finance report that Dyson has called on the government to encourage more people to return to their offices, claiming the chances of the next generation will suffer if home working continues. Dyson says we risk creating a 2-tier workforce, with those at home becoming less and less effective, leaving those diligently attending the workplace to drive the business forward.
I personally hated being in an office, but from a productivity and collaboration point of view, it kind of has a point for many jobs. At home, you can't jump out of your seat and go grab someone. Oftentimes with remote working, you have to wait a long time to get a response that in the office would have been instant. But there's a strong feeling on this channel that current working conditions are outdated and uncaring, with staff often treated like disposable slaves instead of people with lives outside of their 9 to 5. Perhaps a balance between office and remote working needs to be found that is a win-win for everyone.
In the world of crypto, the FCA, the UK's finance watchdog, is at it again, dictating to investors what they can and cannot do. This time they've declared Binance is not capable of being supervised and poses a significant risk to consumers. For those not familiar with crypto, Binance is the world's biggest crypto exchange platform.
In the past few weeks, Binance has come under pressure from regulators across the world due to concerns over the use of crypto in money laundering and the risks it poses to consumers, FinanceMonthly.com reports. In June, the FCA banned Binance from conducting any regulated activity within the UK and placed numerous requirements on the platform.
Earlier, the FCA had banned Binance from undertaking regulated activities in the UK and ordered the platform to remove all advertising and financial promotions. But the regulator is unable to stop Britons using Binance.com as the website is not connected to its UK entity.
On the gold front, the BBC has reported that the Royal Mint has recorded a 5-fold rise in young adults taking a stake in the precious metal. The Mint, which is wholly owned by the Treasury, says investors were attracted to its new digital platform. The investments are backed by gold stored in the Royal Mint's vaults.
We have no doubt that the service is good, but it comes with a heavy price, which is high buy and sell fees and a chunky annual storage fee. There are much cheaper alternatives like the iShares Physical Gold ETF, which only charges 0.15% annually and has an indicative spread of 0.08% when you buy and sell. ETFs and gold vault services like that offered by the Royal Mint both suffer from the same issue. If you don't physically hold the gold, is it really doing its main job of protecting you from economic collapse? As the saying goes, if you don't hold it, you don't own it.
Interactive Investor, the second largest investment platform in the UK, is lining up bankers for a blockbuster London flotation that could value it at up to £2 billion, reports Sky News. If you're an investor who wants to invest in the very concept of investing, this popular broker might be the stock to back. The initial public offering is likely to be amongst the city's most prominent in 2022.
The company has more than 400,000 customers and £55 billion of assets under management. Personally, Interactive Investor is one of our favourite heritage investment platforms, but we imagine any stock market listing would overvalue the company. There is a lot of increased competition from new entrants who are adopting the commission-free investing model. This trend isn't going away, and we think it seriously challenges the incumbent platform's business models.
And finally, Yahoo Finance reports that due to COVID lockdowns, Britons made additional savings of £190 billion over the last 18 months. But this is a drop in the ocean when it comes to plugging the savings gap. Despite lockdown savings, to feel financially secure, the average UK adult requires a nest egg of £17,465, but is falling short of this goal by £7,220. This means, overall, Britons are facing a £371 billion savings shortfall when it comes to feeling able to withstand a financial shock.
A third of men and almost 2/5 of women said greater financial security would make them feel less anxious or depressed. Constantly worrying about money is no way to live. Best of luck to them.
Question of the day. Do you think people should be going back to the office? And what do you think of the contactless payment limit? Join the conversation in the comments below.
Thanks for watching. On this channel we talk a lot about personal finance, investing and all things money. And if you want to see more great content, please click the subscribe button below.
This is MoneyUnshackled.com. See you next time.